We all feel inflation when we buy groceries or fill up the gas tank, but it affects more than just day-to-day expenses. It can change the story your financial statements are telling, sometimes in subtle ways. Let's talk about where those changes happen and why they matter. When inflation ramps up, your direct production costs, like raw materials, labor, or utilities, can climb too. If your selling prices don't keep pace, your profit margin may start to feel squeezed. However, if the market lets you, even modest price adjustments can help keep things steady. If your loans are tied to variable rates, the interest expense can drift upward when inflation points upward. Central banks often use rate hikes to tame inflation, which can raise the cost of borrowing, even if your loan terms don't immediately change. Which inventory method should you use? First in, first out, or FIFO leaves earlier and thus cheaper costs in the cost of goods sold, showing a relatively healthier margin compared to last in, first out, or LIFO. LIFO applies more recent and often higher inflation-affected costs to your expenses. That choice can really shift how your bottom line appears. When it comes to balance sheets, think of assets showing at historical costs versus current values. The price you paid years ago may not reflect its actual worth today if inflation's been climbing. That gap can make your financial health look different than it really is. When prices climb, a boost in revenue might just be from higher prices, not more business. It's easy to be misled by cash flows that look strong but don't necessarily reflect volume or healthy demand. So it's wise to break down sales by units or customers, not just dollars. When building next year's budget, comparing to historical data can be tricky as those numbers were shaped by different price conditions. In today's environment, using inflation-adjusted or forward-looking assumptions can help make your forecasts more grounded. In some sectors, businesses can raise prices faster than inflation, pushing up margins. But that isn't universal. Overcharging, or just appearing to, can invite scrutiny to erode brand trust, so pricing power needs to be managed carefully. Here's the bottom line. Inflation influences everything from production costs to forecasting, and from pricing strategies to how your balance sheet looks. It's worth thinking through each piece so your financial picture stays manageable and accurate.